Hey, what's up, guys? So I've recently had some questions from people about Trump's tax plan and what it would mean for real estate. So I'm going to dive into that on this video. So first, this is not a political video. I'm just giving my unbiased opinion from a real estate perspective. Granted, a lot of this could change with whatever the Senate decides upon. So this is just based off the House proposed plan. So I'm going to go through the big changes and tell you whether or not I think it's good or bad for real estate. The first potential negative is that it would reduce the value of mortgage interest deduction cap from $1 million to $500,000. So it puts the $500,000 cap on new buyers but keeps the $1 million cap for existing homeowners. So if you don't know what I'm talking about, homeowners are able to deduct all of their mortgage interest each year. This is really a great tax break that we have and a major incentive for owning a home. So this won't affect most people in Grand Junction because we don't have a lot of $500,000 plus homes, but it makes owning a high-priced home a lot more expensive. So overall, I think this change isn't a huge deal and might actually be a good cut. Next, the second big change is that the bill requires people to stay in their homes longer to get capital gains exemption. One major advantage of owning a home currently is that if you live in a home for 2 of the past 5 years, then you don't have to pay any taxes on up to $250,000 of capital gains that you've made. The new proposed change will make it so you have to stay in your home longer if you don't want to get heavily taxed on your gains. So you'll have to live in your home 5 of the last 8 years to see no capital gains. This is a major hit to homeowners who want to live in a home and then in a couple of years sell. And I know personally this could potentially change my investment decisions, and instead of selling a home right away, I would choose to maybe hold on to it and rent it out. Next, currently homeowners are able to deduct all of their property taxes, but the new bill would put a cap on deducting property taxes up to $10,000 a year. So this is another one that may be a good change because most Americans don't see anything near $10,000 in taxes, but it could affect luxury markets across the board. So I'm going to chalk this one up as a good change, specifically for Grand Junction market, but New York, on the other hand, not so much. The bill would also eliminate the deduction for moving expenses. So right now we can deduct moving expenses from our taxes. This shouldn't affect people's decision whether or not to move, but it could hurt someone if their moving expenses are upwards of $5,000 to $10,000. Another change is the bill makes second homes and vacation homes much more expensive. This is going to have a big effect on markets like Vail. So if you own a secondary home or vacation home, you won't be able to deduct your mortgage interest, which will reduce the buying power. The bill is good for investors, though. So one thing is investors can now deduct their interest on their loans and property taxes without any cap, because those are itemized deductions for investment property and they're deductions in net rental income. So if you operate your real estate investments through an LLC or a partnership, then the tax rate will actually be at a 25% tax rate, which will be a benefit for those people. So hopefully I was able to explain this because it can be a little bit complex, but overall my conclusion is this. So one, a seller won't be exempt from capital gains if you lived in the property less than 5 years. This is the major negative of the bill in my opinion. Two, buyers might not be able to deduct all of their interest if they are buying a home $500,000 plus, and any buyer won't be able to deduct moving expenses. This is a minor negative in Grand Junction because most homes are below $500,000. Three, homeowners won't be able to deduct all of their property taxes. So if there are more than $10,000, then they can't deduct it. In my opinion, this is a positive. If you're able to afford a home with $10,000 plus in property taxes, you probably don't need to deduct that small amount. Four, so second homeowners won't be able to deduct mortgage interest. This is going to affect the vacation home markets like Vail, so I'm kind of impartial on this because it doesn't have an effect in Grand Junction. So overall, I would say this proposed tax bill is not great for real estate. It will hurt sellers who have to move before 5 years, but it will reduce the amount of taxes and interest that higher income earners can make. So if the Senate is able to change the capital gains portion, then I would be all for it. So let me know your thoughts in the comments below. It's a big bill. It's a potentially big change, and I want to know exactly what you guys think and maybe if you like it and maybe if you hate it. So if you guys have any questions, please let me know. I've really enjoyed researching this and getting to know more about what this tax bill is going to do. And look forward to hearing from you. Thanks.